for this session, we will study standard costing. So managerial accounting provides information to managers so that they can effectively and efficiently manage an organization. We will look at what managers do, the information that they need, the general business environment in which managers function, and the importance of business ethics. So a standard is a benchmark or norm for measuring performance. In managerial accounting, two types of standards are commonly used by manufacturing, service, food, and not-for-profit organizations. First is your quantity standards, specify how much of an input should be used to make a product or provide a service. A auto service centers like Firestone and Sears set labor time standards for the completion of work tasks. B. Fast food outlets such as McDonald's have exacting standards for the quantity of meat used in a sandwich. Second is your cost or price standards, which specify how much should be paid for each unit of the input. For example, hospitals have standard costs for food, laundry, and other items. Home construction companies have standard labor costs that they apply to subcontractors such as framers, roofers, and electricians. Management by exception is a system of management in which standards are set for various operating activities with actual results compared to these standards. Any deviations that are deemed significant are brought to the attention of management as exceptions. We will apply the management by exception principle to quantity and cost standards with an emphasis on manufacturing applications. The variance analysis cycle is a continuous 5-step process. First, the beginning cycle. The cycle begins with the preparation of standard cost performance reports in the accounting department. Second, these reports highlight variances that are differences between actual results and what should have occurred according to the standards. Third, variances raises questions such as why did this variance occur and why is this variance larger than what is last period. Fourth, significant variances are investigated to discover their root causes. And last, corrective actions are taken and the next period's operations are carried out. Our objective is to correct problems that caused unfavorable variances and to possibly adopt and reward the practices that resulted in favorable variances. Setting price and quantity standards require the combined expertise of everyone who has responsibility for purchasing and using inputs. In a manufacturing setting, this might include managerial accountants, engineers, purchasing managers, production managers, line managers, and production workers. Standards should be designed to encourage efficient future operations, not just a repetition of past inefficient operations. Ideal standards can only be attained under the best of circumstances. They allow for no work interruptions and they require employees to continually work at 100% peak efficiency. Practical standards are tight but attainable. They allow for normal machine downtime and employee rest periods and can be attained through reasonable, highly efficient efforts of the average worker. Practical standards can also be used for forecasting cash flows and in planning inventory. The standard price per unit for direct materials should reflect the final delivered cost of the materials, net of applicable discounts. Standard quantities are amounts needed to meet the production designs. The standard quantity per unit for direct materials should reflect the amount of material required for each unit of finished product, as well as an allowance for unavoidable waste, spoilage, and normal inefficiencies. A bill of materials is a list that shows the quantity of each type of material in a unit of finished product. TQM advocates argue that waste and spoilage should not be tolerated. If allowances for waste and spoilage are built into the standard quantity, the level of those allowances should be reduced over time. Instead of the terms price and quantity used for material, we use rate and time when we apply standard costs concepts to direct labor. Labor rates can be determined by wage surveys of rate paid in comparable companies or by labor contracts. The standard rate per hour for direct labor includes not only wages earned but also fringe benefits and other labor costs. Many companies prepare a single rate for all employees within a department that reflects the mix of wage rates earned. The standard hour per unit reflects the labor hours required to complete one unit of product. Standard times can be determined by using available references that estimate the time needed to perform a given task, or by relying on time and motion studies. For variable manufacturing overhead, we use a rate which is the variable portion of the predetermined overhead rate. The activity standard is the units of activity in the base used to apply or predetermined overhead. Examples of activity base might be direct labor hours or machine hours, depending on which is used as the allocation base in the predetermined overhead rate. The standard cost card is a detailed listing of the standard amounts of direct materials, direct labor, and variable overhead inputs that should go into a unit of product, multiplied by the standard price or rate that has been set for each input. As we've seen, a budget deals with total costs. Standards are calculated on a per unit basis and can be viewed as the budgeted cost for one unit of product. Standards are often used in the preparation of budgets. Price and quantity standards are determined separately for two reasons. First, different managers are usually responsible for buying and for using inputs. For example, the purchasing manager is responsible for raw material purchases. The purchasing manager is responsible for raw material purchase prices, and the production manager is responsible for the quantity of raw material used. Okay, so there's a difference between the role of the purchasing manager, which is his role is to know the raw material purchase prices, while the responsibility of the production manager is to determine the quantity of raw materials used. The second reason is that the buying and using activities occur at different points in time. For example, raw material purchases may be held in inventory for a period of time before being used in production. Price variances result when we pay an actual price for a resource that differs from the standard price that should have been paid. Quantity variances are caused by using an actual amount of resource that differs from the standard amount that should have been used. The act of computing and interpreting variances is called variance analysis. Price and quantity variances can be computed for all three variable cost elements: your direct materials, your direct labor, and your variable manufacturing overhead, even though the variances have been different names as shown. So we have here the general model for variance analysis. Um, Here's a general model for computing standard cost variances. We multiply the actual quantity times the actual price and compare to the actual quantity times the standard price. The difference is the price variance. Then we compare the actual quantity times the standard price to the standard quantity at the standard price. The difference is the quantity variance. Although price and quantity variance are known by different names, they are computed exactly the same way for direct materials, direct labor, and variable manufacturing overhead. So this general model would be your guide. This would be your cheat code for you to memorize the standard costing. Actual quantity represents the actual amount of direct materials, direct labor, and variable manufacturing overhead used. The standard quantity represents the standard quantity allowed for the actual output of the period. The actual price represents the actual amount paid for the input used. The standard price represents the amount that should have been paid for the input used. We can reduce these relationships to mathematical equations as shown in your screen. For example, we can determine the price variances by subtracting the actual quantity times the standard price from the actual quantity times the actual price. And we can determine the quantity variance by subtracting the standard quantity times the standard price from the actual quantity times the standard price. Here's an example that will give us an opportunity to complete the material price and quantity variances. So be familiar with the given. So Glacier Peak Outfitters has the following direct material standard for the fiber fill in its mountain parka. So 0.1 kilogram of fiber fill per parka at $5 per kilogram. Last month, 210 kilograms of fiber fill were purchased and used to make 2,000 parkas. The material cost a total of $1,029. Okay, so let's now move to the solution. Okay, so but the materials price variance, the difference between what is actually paid for a quantity of materials and what should have been paid according to the standard, is $21 favorable. The material price variance is favorable because the actual price was less than the standard price by 10 cents per kilogram. The material quantity variance, which is the difference between the standard cost of materials actually used in production and the standard cost of the quantity that should have been used, is $50 unfavorable. The material quantity variance is unfavorable because the actual quantity exceeds the standard quantity allowed by 10 kilograms. Here, the actual price is $4.90 per kilogram. It is computed by dividing the actual cost of the material by the actual number of kilograms purchased. The standard quantity of materials is 200 kilograms, computed by multiplying the standard quantity per parka times the number of parkas made. So here we have your material variances using the factored equations. So the equations that we have been using thus far can be factored and used to compute the material price and quantity variances. We can determine the material price variance by multiplying the actual quantity times the difference between the actual price and the standard price. Okay, so we have here your actual quantity of 200 kilograms multiplied by the difference between your standard and actual price. We have here $21 favorable. We can determine the material quantity variance by multiplying the standard price times the difference between the actual quantity and the standard quantity. So we have here your standard price of 5 kilograms, okay? And we have here your actual quantity of 210 kilograms, less your standard quantity of 200 kilograms, thus giving you a $50 unfavorable amount. Most companies compute the material price variance when materials are purchased. They calculate the materials quantity variance after materials are used in production. The material price variance is computed using the entire amount of material purchased during the period. The materials quantity variance is computed using only the portion of materials that was used in production during the period. The purchasing manager and production manager are usually held responsible for the material price variance and the materials quantity variance respectively. The standard price is used to compute the quantity variance so that the production manager is not held responsible for the performance of the purchasing manager. The materials variances are not always entirely controllable by one person or department. For example, the production manager may schedule production in such a way that it requires express delivery of raw materials, resulting in an unfavorable materials price variance. The purchasing manager may purchase lower quality raw materials, resulting in an unfavorable materials quantity variance for the production manager. In this example, since its performance evaluation is negatively impacted by the unfavorable material quantity variance, the production manager is trying to find reasons for the unfavorable variance other than his own production operation. So let's have a quick check, quick exercise. In this example, the company produces a zippy. The direct materials standard calls for 1.5 pounds per zippy at $4 per pound. Last week, Hanson purchased and used 1,700 pounds of materials to produce 1,000 zippies. The 1,700 pounds of material cost a total of $6,630. Now, we will see several questions based on the information on this screen. Okay, so take notes as we answer this um, problem. Okay, so familiarize it first. So here's the question. Hanson's material price variance for the week was, okay, so let's compute for that. So these are your choices, but let's disregard the choices first and go with the solution. So the answer here is $170 favorable. Okay? We find the material price variance by multiplying the actual quantity of material purchased times the difference between the actual price per pound and the standard price per pound. We find the actual price per pound by dividing the $6,630 total actual price paid for the material by the 1,700 pounds purchased. Okay? The $170 favorable material price variance results because Hanson paid 10 cents per pound less than the standard for 1,700 pounds of material. Okay, next question. Know your material quantity variance. So for this, the answer would be $800 unfavorable. The standard quantity is the amount of material that Hanson should have used to make 1,000 zippies. We find the standard quantity by multiplying the 1.5 pounds per unit standard for one zippy times the 1,000 zippies. Now that we know the standard quantity, Let's calculate the material quantity variance. We find the material quantity variance by multiplying the standard price for 1 pound of material times the difference between the actual quantity of material and the standard quantity of material. The $800 unfavorable material quantity variance results because Hanson used 200 pounds more than the standard to make 1,000 zippies, and each pound of material is a standard price of $4. Here, we see a summary of the material price and quantity variance computations in a convenient three-column format. You may find this three-column format more helpful than the equations that we used to answer the previous two questions. Okay, so let's extend the Hudson example by increasing the quantity of material purchased to 2,800 pounds at a total cost of $10,920. All other information is the same as before. Okay, so in here, Hanson actually paid $10,920 for the 2,800 pounds of material. Multiplying the standard price of $4 per pound times the 2,800 pounds of material purchased, you find that Hanson should have been paid $11,200 more. The price variance is now $280 favorable. The price variance increases in this example because the quantity purchased increased. The $280 favorable material price variance results because Hanson paid 10 cents per pound less than the standard for 2,800 pounds of material. The material quantity variance, or MQV, is the same as before because Hanson again used the same amount of material as before to make the same number of zippies. Okay. So now let's turn our attention back to Glacier Park Outfitters to illustrate the computation of labor rate and efficiency variances. So in here, um, 1.2 standard hours for parka at $10 per hour. So last month, employees actually worked 2,500 hours at a labor cost of 26,250 to make 2,000 parkas. Okay, so here, the labor rate variance, the difference between the actual cost for labor and the total amount that should have been paid for the actual hours worked, is $1,250 unfavorable. The labor rate variance is unfavorable because the actual average wage rate is 50 cents per hour more than the standard wage rate. The labor efficiency variance, the difference between the standard cost of the actual hours of labor used in production and the standard cost of the hours that should have been used, is $1,000 unfavorable. The efficiency variance is unfavorable because the actual quantity of hours is 100 hours more than the standard quantity of hours allowed. The actual wage rate is $10.50 per hour, div- computed by dividing the actual cost for labor by the actual number of hours worked. The standard quantity of labor hours is 2,400 hours, computed by multiplying the standard hours for one parka times the number of parkas made. Here, your labor variances using the factored equations. The equations that we have been using thus far can be factored and used to compute the labor rate and efficiency variances. For your labor rate variance, it is determined by multiplying the actual hours times the difference between the actual rate and the standard rate. For the labor efficiency variance, it is computed by multiplying the standard rate times the difference between the actual hours and the standard hours. Labor variances are partially controllable by employees within the production department. For example, managers, for example, production managers or supervisors can influence the first deployment of highly skilled workers and less skilled workers on tasks consistent with their skill levels. Second, the level the level of employee motivation within the department. Third, the quality of production supervision. And last, the quality of the training provided to the employees. Labor variances are not entirely controllable by one person or department. For example, the maintenance department may do a poor job of maintaining production equipment. This may increase the processing time required per unit, thereby causing an unfavorable labor efficiency variance. The purchasing manager may purchase lower quality raw materials, resulting in an unfavorable labor efficiency variance for the production manager. So here, let's return to the hands-on company and compute for labor variances. So the direct labor standard to produce each ZP is 1.5 hours at $12 per hour. Last week, it took 1,550 direct labor hours to produce 1,000 ZPs, and the total labor cost was $18,910. Now, we will see several questions based on the information on the screen. Again, you may wish to take some notes as you answer these questions. Just just as you did with the material variance questions, try to answer each question before advancing to the solution. So here, compute for the labor rate variance for the week. So I'll give you time to answer that. Okay, let's start. So what are your answers? So the answer is A, $310 unfavorable. Why? Okay. So we find the actual labor rate by dividing the $18,910 total labor cost by 1,550 direct labor hours actually worked. Now that we know the actual labor rate, let's calculate the labor rate variance. We find the labor rate variance by multiplying the actual labor hours worked times the difference between the actual rate per labor hour and the standard rate per labor hour. The $310 unfavorable rate variance results because Hanson paid 20 cents per labor hour more than the standard for 1,550 labor hours actually worked. Okay? So next question, compute for your labor efficiency variance. So the answer here would be $600 unfavorable. The total standard hours for labor is the amount of time Hanson's employees should have worked to make 1,000 ZPs. You find the total standard hours by multiplying the 1.5 standard hours for 1 ZP times the 1,000 ZPs made. Now that we know the total standard hours, let's calculate the labor efficiency variance. So we find the labor efficiency variance by multiplying the standard rate for 1 hour of labor times the difference between the actual hours of labor and the standard hours of labor. The $600 unfavorable labor efficiency variance results because hands-on employees worked 50 hours more than the standard to make 1,000 ZPs, and each hour of labor is a standard rate of $12. Okay, so here we have your three-column format. So again, get your price variance, get your efficiency variance, and that's how you determine your $310 unfavorable and your $600 unfavorable as well. Okay. So now that we have studied material and labor variances, let's take a look a let's take a look at variable manufacturing overhead variances. We will return to Glacier Peak Outfitters to illustrate the computation of variable manufacturing spending and efficiency variances. So again here, 1.2 standard hours per parka at $4 per hour. Last month, employees actually worked 2,500 hours to make 2,000 parkas. Actual variable manufacturing overhead for the month was $10,500. So the variable manufacturing overhead spending variance, which is the difference between the actual total cost for variable manufacturing overhead and the total amount that should have been paid for the actual hours work, is $500 unfavorable. The variable manufacturing overhead spending variance is unfavorable because the actual variable manufacturing overhead rate is 20 cents per hour more than the standard variable manufacturing overhead rate. The variable manufacturing overhead efficiency variance, which is a difference between the standard cost of the actual hours used in the production and the standard cost of the hours that should have been used, is $400 unfavorable. The efficiency variance is unfavorable because the actual quantity of hours is 100 hours more than the standard quantity of hours allowed. So the actual variable manufacturing overhead rate is $4.20 per hour. It is computed by dividing the actual cost of variable manufacturing overhead by the actual number of hours worked. So the standard quantity for labor hours is 2,400 hours. It is computed by multiplying the standard hours for one parka times the number of parkas made. So we can determine that the variable manufacturing overhead spending variance by multiplying the actual hours times the difference between the actual rate and the standard rate. We can determine the variable manufacturing overhead efficiency variance by multiplying the standard rate times the difference between the actual hours and standard hours. Again, so let's return to this problem. The variable manufacturing overhead standard to produce each ZP is 1.5 hours at $3 per hour. Last week, it took 1,550 hours to produce 1,000 ZPs. And the total variable manufacturing overhead cost was $5,115. Okay, so now we will see several questions based on the information on this screen. Again, take notes of the given. We will compute for the variable overhead standard variance. Okay. Okay. So you may pause the video so that you can continue with your um, independent solution. Okay. So I'll flash the next screen now, the answer. So the answer here is $465 unfavorable. We find the actual variable manufacturing overhead rate by dividing the $5,115 total variable manufacturing overhead cost by 1,550 direct labor hours actually worked. Now that we know the actual variable manufacturing overhead rate, let's calculate the variable manufacturing overhead spending variance. We find the variable manufacturing overhead spending variance by multiplying the actual hours worked times the difference between the actual variable manufacturing overhead rate per hour and the standard variable manufacturing overhead rate per hour. The $465 unfavorable manufacturing overhead rate variance results because Hanson's actual variable manufacturing overhead rate per labor hour is 30 cents per hour more than the standard variable manufacturing overhead rate per hour for the 1,550 labor hours actually worked. So next question, what is your efficiency variance? Again, you may pause the video so that you can continue with your own solutions. Okay, so the answer here would be $150 unfavorable. The total standard hours is the amount of time Hanson's employees should have worked to make 1,000 ZPs. We find the total standard hours by multiplying 1.5 standard hours for 1 ZP times the 1,000 ZPs made. Now that we know the total standard hours, let's calculate the variable manufacturing overhead efficiency variance. We find the variable manufacturing overhead efficiency variance by multiplying the standard rate for variable manufacturing overhead times the difference between the actual hours of labor and standard hours of labor. The $150 unfavorable manufacturing overhead efficiency variance results because Hanson's employees worked 50 hours more than the standard to make 1,000 ZPs at a standard variable manufacturing overhead rate of $3 per hour. Again, you have here your three-column format. You might be more, you might, you might be, you might find this more convenient with the other methods or other ways of solving the problem, but you'd still be getting or netting the same results. Okay? So when the flexible budget is based on hours of activity, the quantity of hours chosen can be based on actual hours or standard hours allowed for the actual output. If actual hours are used, only a spending variance can be computed. Since the efficiency variance is based on the difference between actual hours and standard hours allowed, if actual and standard hours are used, both a spending and efficiency variance can be computed. Okay. So we will illustrate the computation of variable overhead spending and efficiency variance with an example. Tolnaco's actual production for the period required 3,200 standard machine hours. Actual variable overhead incurred for the period was $6,740. Actual machine hours worked were 3,300 hours. Okay? The standard variable overhead cost per machine R is $2. First, we will compute the variable overhead spending variance using actual Rs. Then, we will use the standard Rs allowed with the actual Rs to produce the variable overhead efficiency variance. So the overhead spending variance is the difference between the actual variable overhead and the flexible budget at actual Rs for variable overhead. We can express this in a formula. The spending variance is equal to the actual Rs times the difference between the actual variable overhead rate and the standard variable overhead rate. Here, we compute the variable overhead variance by taking the difference between the $6,740 actual cost and the $6,600 flexible budget. For the company, the variable overhead spending variance is $140 unfavorable. The variable overhead spending variance may contain both price and quantity components. Cost unfavorable spending variance may be due to variable overhead resources costing more than costing more to purchase than standards allow, or it may be caused by using more of the favorable overhead resources than standards allow. The general model for computing both variable overhead variances is now shown on your screen. Note that the efficiency variance is based on the difference between actual Rs and standard Rs. So let's use again the COLACO um, given. Here we see the computation of the efficiency variance in addition to the spending variance that we computed earlier. The total variable overhead variance is the combination of the spending variance and the efficiency variance. $340 unfavorable. Okay, so get the total of your spending and efficiency. That is your unfavorable flexible budget total variance. The efficiency variance estimates the indirect effect on variable overhead of the efficiency in the use of the activity base. Those who control the activity base are responsible for the efficiency variance. Next, we will look at two questions that will require us to compute variable overhead spending and efficiency variances. Here, the question is that what is the spending variance? So we have here 2,100 standard direct labor hours. You also have your actual variable overhead of $10,950. Actual direct labor hours work at 2,050 hours. And a predetermined variable overhead rate at $5 per direct labor hour. Okay. So the answer here would be $700 unfavorable. The spending variance is the difference between the actual variable overhead incurred and the flexible budget at the actual hours. Actual variable overhead is $10,950. The flexible budget amount is obtained by multiplying the standard rate of $5 per hour times 2,050 actual hours. Okay, so next question, you are asked for the efficiency variance. Okay, so you may pause the video first. Okay, so the answer here would be $250 favorable. The variable overhead efficiency variance is found by multiplying the standard variable overhead rate of $5 per hour times the difference between 2,050 actual hours and the 2,100 standard hours. Since the actual hours are less than the standard hours, the efficiency variance is favorable. Again, you have your three column format. You may find this more um, useful for you. Again, get the net of your spending and efficiency variance. You will get your flexible budget total variance. It is unlikely that all variable costs within a company are driven by a single factor, such as the number of units produced, labor hours, or machine hours. Activity-based costing offers a way to recognize the presence of more than one activity base within a company to evaluate overhead spending for each activity cost pool that has its own respective activity measure. So, overhead costs are assigned to products by multiplying the predetermined overhead rate times activity. The estimated total units in the base of the rate is called the denominator activity. The predetermined overhead rate can be broken down into fixed and variable components. As we have already seen, the variable overhead component is useful for preparing and analyzing variable overhead variances. We will soon see that the fixed overhead component is useful in preparing and analyzing overhead variances. In a normal cost system, overhead is applied to work in process on the basis of the actual number of hours worked. In the standard cost system, overhead is applied to work in process based on the standard hours allowed for the product of the period. Here, we see the general model for computing fixed overhead variances. The fixed overhead budget variance is the difference between the actual fixed overhead incurred and the budgeted fixed overhead. The volume variance is the difference between budgeted fixed overhead and the fixed overhead applied production. In equation form, the volume variance is equal to the fixed portion of the predetermined overhead rate times the difference between the denominator hours and the standard hours allowed. So, Colaco prepared a flexible budget for overhead at two levels of activity, 3,000 machine hours and 4,000 machine hours. Notice that the total variable overhead increases when activity increases, while the total fixed overhead is the same at both levels of activity. So we calculate the variable overhead rate by dividing the total variable overhead by the activity in machine hours. Okay? The variable overhead rate of $2 per machine hour is the same for both levels of activity. Notice that this is the same variable overhead rate that we used in the previous Colaco example. So to get the fixed overhead rate, you have here $3 and 2.25. We calculate the fixed overhead rate by dividing the total fixed overhead by the activity in machine hours. The fixed overhead rate differs at each level of activity. It declines as activity increases because we are dividing a fixed total by an increasing activity. Total predetermined overhead rate is the sum of the variable and fixed rates. Okay. So we will continue the Colaco example to illustrate fixed overhead variance computation. Because the fixed overhead rate differs at different activity levels, an activity level must be chosen. Colaco decided to base its predetermined overhead rate on 3,000 machine hours. Now, let's focus on the computations for fixed overhead variances. The fixed overhead budget variance is difference between $8,450 and the actual fixed overhead incurred and the $9,000 fixed overhead budget. Since the actual fixed overhead is less than the budget for fixed overhead, the budget variance is favorable. The fixed overhead budget variance is the difference between the amount that had been spent and the amount that was actually spent for fixed overhead. The volume variance is the difference between the budgeted fixed overhead and fixed overhead applied to production. The fixed overhead the fixed overhead applied is computed by multiplying the 3,200 standard hours allowed times the $3 fixed portion of the predetermined overhead rate. Since the budgeted fixed overhead rate is less than the applied fixed overhead, the volume variance is favorable. An unfavorable volume variance results when the standard hours allowed are less than the denominator hours. A favorable volume variance results when the standard hours allowed are greater than the denominator hours. The volume variance does not measure over or underspending. It is a measure of utilization of facilities. In essence, the volume variance is the error that occurs as a result of treating fixed overhead as, as though it were a variable cost. Next, we will look at two questions that will require us to compute fixed overhead budget and volume variances. So here's the first question. So you have 2,100 standard direct labor hours, actual fixed overhead of $14,800, budgeted fixed overhead of $14,450, and the predetermined fixed overhead rate at $7 per direct labor hour. So what is your budget variance? So the answer there would be $350 unfavorable. The fixed overhead budget variance is the difference between $14,800 of the actual fixed overhead incurred and the $14,450 fixed overhead budget. Since the actual fixed overhead is greater than the budgeted for fixed overhead, the budget variance is unfavorable. Next question, compute for the volume variance. Again, you may pause at this moment to compute for your own solution. So the answer here would be letter B, $250 favorable. The volume variance is a difference between the $14,450 fixed overhead budget and the $14,700 of fixed overhead applied to production. The fixed overhead applied is computed by multiplying the 2,100 standard hours times the $7 fixed portion of the predetermined overhead rate. Since the budgeted fixed overhead is less than the applied fixed overhead, the volume variance is favorable. Again, that is your answer, 250 favorable. Here, again, your three-column format, just in case this would come in more handy for you. The total fixed overhead variance is the combination of the unfavorable budget variance and the favorable volume variance. $100 unfavorable. Often, it's helpful to look at the fixed overhead relationships in graphical form. We will use the COLA-CO data from the previous example for a graphical approach. So here, if more of you are more of a visual person, so this might be more useful for you or helpful for you. Fixed overhead cost is plotted on the vertical axis and the activity in machine hours is plotted on the horizontal axis. The fixed overhead budget is $9,000 at the 300,000 hours of denominator level of activity. The line from the origin sloping upward to the right represents the application of fixed overhead to production. The slope of this line indicates that the fixed overhead is applied at a rate of $3 per machine hour. Note that the total amount of fixed overhead applied is equal to the budgeted amount of fixed overhead only at the denominator level of activity because we are treating $9,000 of fixed overhead as if it were a variable cost of $3 per machine hour. Next, we enter the actual amount of fixed overhead on the graph. The broken horizontal line below the budgeted final fixed overhead represents $8,450 of actual fixed manufacturing overhead. The vertical distance between the budgeted fixed overhead line and the actual fixed overhead line represents the fixed overhead budget variance of $550. Since the actual overhead is less than the budgeted fixed overhead, the fixed overhead budget is variance favorable. Next, we enter the 3,250 hours of activity on the horizontal axis and the $9,600 of applied fixed overhead on the vertical axis. The vertical distance between the budgeted fixed overhead line and the applied fixed overhead line represents the fixed overhead volume variance of $600. Since the budgeted fixed overhead is less than the applied fixed overhead, the volume variance is favorable. In a standard cost system, the sum of the overhead variances equals the under or over applied overhead for a cost for a period. Unfavorable variances are equivalent to under applied overhead. Favorable variances are equivalent to over applied overhead. All variances are not worth investigating. Methods for highlighting a subset of variances as exceptions include looking at the size of the variance and looking at the size of the variance relative to the amount of spending. Again, judgment is used. Thus, we have to consider the concept of materiality. We have here a statistical control chart. Plotting variance analysis data on a statistical control chart is helpful in variance investigation decisions. Variances are investigated if they are unusual relative to the normal level of random fluctuation and an unusual pattern emerges in the data. Standard costs systems offer many advantages, including standard costs are a key element of the management by exception approach that helps managers focus their attention on the most important issues. Standards that are viewed as reasonable by employees can serve as benchmarks that promote economy and efficiency. Standard costs can greatly simplify bookkeeping. Standard costs fit naturally into a responsibility accounting system. So the use of standard costs can also represent a number of problems. Standard cost variance reports are usually prepared on a monthly basis and are often released days or weeks after the end of the month. Hence, the information can be outdated. Again, time is of the essence. If variances are misused as a club to negatively reinforce employees, morale may suffer and employees may make dysfunctional decisions. Labor variances make two important assumptions. First, they assume that the production process is labor-paced. If labor works faster, output will go up. Second, the computations assume that the labor is variable cost. These assumptions are often invalid in today's automated manufacturing environment where employees are essentially a fixed cost. In some cases, a favorable variance can be as bad or worse than an unfavorable variance. Excessive emphasis on meeting the standard may overshadow other important objectives such as maintaining and improving quality, on-time delivery, and customer satisfaction. Just meeting standards may not be sufficient. Continual improvement may be necessary to survive in a competitive environment. So, last slide. The entries into the various accounts are made at standard cost, not actual cost. Differences between actual and standard costs are entered into special accounts that accumulate the various standard cost variances. Standard cost variances are usually closed out to cost of goods sold at the end of the period. Unfavorable variance increases cost of goods sold, and favorable variances decrease cost of goods sold. So, tip for standard costing, memorize the table. Okay, which table? The very first one. When I say memorize, know it by heart because this will be your foundation. When you memorize this, you just input the given in the problem, so you will already know what is if the answer is favorable or unfavorable. Okay.